this slide only shows how the current trends are going. I'm not going into details. It only shows that the development paths are narrowing. Okay, so that most of the countries in Central Europe, the new member states, but also in the Western Balkans, are now in this range of 3% of economic growth. And this is something that we think that can be upheld in the coming years. The CIS, of course, looks quite different. Now, here are the numbers in detail. And I'm very happy that Doris Ritzberger was showing the forecast of the Austrian National Bank, and I can point out some of the divergences between the two forecasts. So we are a bit more pessimistic as concerns the new EU member states, and we are a bit less pessimistic as concerning Russia. So there are three blocks of countries I can show you here. One is where we have quite a standard rate of about 3% economic growth and even above, but not that much above the 3% as the Austrian National Bank forecasts. And then we have a bunch of countries which have lower growth, where 2015 was really a peak, and due to the decline in EU transfers and the ongoing internal structural problems, will have a slowdown of economic growth, and the 2015 level may be achieved only in 2018. These are countries that are still having difficulties either with their internal or external debts, that have competitiveness problems. But first of all, it is the rebalancing need that is still ongoing in, for example, in Croatia or Slovenia. As to the CIS, so first of all, Russia, we expect this year another year with economic decline, but that will be the last year, and from there will be an upward trend. There are estimates that dollar price of crude oil of about $30 will ensure that Russia stagnates. If it goes below that, Russian GDP will fall. If it goes above that, there are chances that it will recover and have some growth. So the adjustment has taken place up to now, and now if we have a slightly higher oil price, there will be room for Russia to recover. Of course, it's quite a sad story that a traditional, well-industrialized, large economy is that much dependent on commodity exports. Okay, now what are the major growth drivers? First of all, household consumption, and that is the yellow bar. But also gross fixed capital formation, which is the blue bar, is contributing positively to growth in most countries. Here we have the new EU member states. There are some slow growth countries, as I pointed out earlier, which are still in the process of rebalancing and can afford much less spending on consumption. And some of them, like Hungary, are seriously hit by lower EU transfers for investments this year, and the slow recovery is coming only later on. Croatia is actually quite a surprise. Already last year, it has come out from a half a decade stagnation or decline, and partially this is the effect of European Union membership, partially due to some structural changes they have carried out, for example, in the shipbuilding industry. The country that has the most stable growth is Poland. Poland has a quite complexly structured economy with a strong domestic small and medium-sized private sector, and has kept its external balances also rather under control. The slow or some decline of growth that is shown here with the black points is actually the result that we have factored in some of the institutional risks that appeared due to the new populist government. Romania is another case of itself. There, the former socialist government undertook fiscal easing, quite rapid support to private consumption, and it is expected that this will overstrain the budget, and we can see a setback in 2017. Okay, another group of countries, the Baltic countries, where first of all Estonia has been quite hard hit by the Russian crisis, the commodity crisis, which actually also had its transfer to Finland. So both main trading partners of Estonia was in recession in the last year or two. So coming out from there, that position through structural change and reorientation will take some time. So coming over to the Western Balkans, here we have, as a surprise, two countries that were formerly very much lagging behind, Albania and Kosovo. Now they are showing remarkable growth, first of all, in case of Albania through investments, which are mainly infrastructure investments, gas pipeline, power stations, and so on. Serbia is a country that is just coming out from a recession, has still very serious structural changes and problems ahead, but we are thinking that the forthcoming government will be able to solve this and at least keep the growth rate marginally positive. Now, as to Russia, I was already explaining that what led to the fall of growth into the negative. The adjustment is clearly visible. It is a contraction of household consumption, but also of investments. Even more contraction can be seen for Ukraine, but the adjustment process seems to have come to an end, and at least from that very low level, one can expect that the country will at least stabilize its performance. Investments should underpin future growth, and that is what is in the focus of our report. Some decline in 2016 due to less EU funds and more upward trend in the coming years. Of course, these investment rates are much lower than before the crisis and will still need to have some more time to come back to those levels, which is perhaps also unattainable. Now here we have two sides, the private investments, which are at about 80% of the investments, and public. So first, the conditions for the private investment side, we can see first signs of improving conditions. Like bank loans, for example, as the chart shows that the big deleveraging is coming to an end. In some countries, we have already a little pickup of bank loans to the economy. We can also see that the non-performing loan rate is going back. As to FDI, data are inconclusive, but if we look at the newly established greenfield investment projects, 2015 and the beginning of 2016 was somewhat better than the earlier 3-4 years. But of course, major part of the private investments are financed not by bank loans but by retained profits. And these retained profits have increased quite heavily last year, so we can expect that much of that will be invested. Okay, conditions for public investment depends on the fiscal space. And here I just put these 4 quarters in the chart showing, at least according to the excessive deficit procedure, the -3% deficit to GDP and the general government debt above 60%. And here we can see definitely a quarter where countries are still in high debt and have also areas where they are in the course of adjustment. They have adjusted already their budget balances, but the indebtedness is high. That segment has high debt and also high deficits. So in those countries, we can expect a further adjustment going on. But the majority of countries is actually here quite small deficits and minor government debt. Those are the countries which may have some fiscal space to underpin economic growth and to undertake public investments. Actually, the adjustment was tremendous in all these countries. If you look at the interest payments and primary balances here in 2013 and compare them with 2015, you can see how much the deficits have shrank over just 2 years. And here again, we have certain countries which have low overall deficits and still producing primary surpluses. And these are the countries that may have some leeway for introducing some growth-stimulating efforts. One of these countries is Romania, which has actually embarked on a growth-stimulating fiscal policy effort, decreasing the VAT rate, which is, of course, may not be the proper policy to put more public money or allow more public money in consumption and not so much to investments. So it would have been better choice, perhaps, for the case of economic growth, to spend more on investments. We have, of course, another side of the coin. If you look at the inefficiency of public investments in the country, maybe it's just better to distribute the money to the population and not distribute it through inefficient investments and corrupt money. Okay, another feature of the public investments, but that I mentioned before, is that we are in the end of one of the European financing periods. 2015 was the last year when the finances from the period up to 2013 could be reimbursed. There is a fallback in transfers this year, as the new financing period is just getting on. Of course, countries are different to the extent they depend on this EU money. So especially the countries here, we can see that they are very much dependent on these EU transfers. So if the EU transfer declines, public investments also decline very seriously. This chart gives an overview of how actually this net financing position towards the European Commission increased first from 1.3% up to 6% of GDP. And then the forecast is that it's come back to 1 to 2.5%. Now it is the same time we have the European Fund for Investments, the Juncker plan, that is taking shape. And the question would arise whether this would be a substitute for declining transfers. Well, our analysis shows that it's not. The figure 0.5 to 1.5% of GDP is actually calculated as if the East European member states would get these loans according to their GDP. But it is already visible that they either lack projects that can be financed by those European loans, or they are even not applying for it because they think that for much of these investments there will be free money available through the capital transfers in the coming years. Now, to underpin even more the magnitude of what happened here by EU transfers, if we calculate that about half of those 6% of GDP, so about 3%, is really capital transfer that is visible in the capital accounts of these countries. And you compare that, for example, with the net inflow of foreign direct investments, we can see how really important EU transfers have become. So foreign direct investments are between 0 and 1.5% of GDP only. Yeah? So it is now this kind of publicly initiated financing, very much in front of grants, that is supporting growth in the new member states, and much less the productive investments of companies. Okay, just pointing out that the current account deficit shrank, surpluses increased. It's just a way of showing that the adjustment is going on also on the international financing side. What is interesting here to see the current account, capital account, and financial account, how they are related to each other. And this again shows by the yellow bars that capital transfers, which are mainly for the EU members' European funds, have contributed 1 to 3%, 4% of GDP, only the transfers, so not including agriculture and so on. And this is all the more necessary because, as you can see, there is a negative inflow on the financial account. Okay, so these countries are still in a deleveraging phase. The Western Balkans is quite different in this respect. You have huge current account deficits financed by inflow of money of all sorts on the capital and, first of all, the financial account. Those are the countries that still suffer from a rather big inability to export. So the West Balkan countries are still not, cannot base their economy on exports. Whereas in the Central European countries, it is more the case that they have achieved a big surplus on their exports. So Czech Republic, Hungary, and so on, they have huge export surpluses, even if the current account surplus is very small, like in the Czech Republic. Here the major item is the income owned by the foreign investors. So the income of the foreign investors, which is calculated with a negative sign in the current account, is balanced by the positive sign of the goods exports, which is mainly actually produced by those foreign companies that were established in the course of the last, well, about 15 years of rapid FDI inflow. So we have here quite different structures of the economies and also quite different vulnerabilities. So for the Central European countries to keep up this kind of economic structure will need a constant new inflow of FDI to modernize, upgrade, and at least to keep those export industries intact. For the West Balkan countries, we need to build up more export capacities that would contribute to reducing this high dependence on inflows. And here I come to another interesting part of the current account, again in the magnitude of some 3% of GDP, which is the private transfers, either by people who are abroad for less than a year, and they earn compensation for their work, or they have settled abroad for a longer period than 1 year, and they produce remittances. And some of these countries, especially in the West Balkans, are very heavily dependent on this kind of inflows. But also, for example, the two countries, Latvia and Lithuania, which underwent a very serious adjustment in their economies. We had huge deep depression some 3 years ago in these countries, and a huge emigration wave. New country coming to this club is Hungary. Even if the data goes only up to 2014, 2015 would be even much higher. So there is a new phenomenon that we have mass-scale immigration, and of course the earnings abroad is contributing to the current account. To further develop on this point, I can show here the effect of natural decline of the population, the darker part, and the migration-related loss in population. This has a long history already since the early 1990s. There is an increase of immigration from these countries. This only shows a small period of time. We can see that some of these countries, actually the same where we have big amounts of remittances and earnings abroad, really lost 4 or 5% of their population. Interesting enough, for example, Hungary, where the natural decline of population is very large, but there is a net immigration because these were the years when the government encouraged actually Hungarians living abroad by giving them Hungarian citizenship also to move to Hungary. Additionally to this, due to the recovery in the economy, we have also an increase in, a decrease in unemployment. And putting the two things together, you can have some idea that there is labor shortage appearing in these countries. So countries moving, developing by about 3%, and the population getting more income, trying to invest in new homes, for example, you will find in many of these countries already a shortage of labor, especially in the construction industry. So labor shortage is actually appearing. It is not only a labor shortage, it's also a population shortage, so less and less contribution, for example, to the social benefit funds and so on. So judging from these trends, it is not really understandable why most of these countries refuse immigration that heavily as they do. Okay, the last slide is just showing the catching up process. This is in per capita GDP and at purchasing power parity. Referring to the previous slide, you can catch up by reducing population, yeah, in per capita GDP terms. But these countries are also catching up, the new member states and the Western Balkans, also by higher rate of economic growth than the European core countries. Now, if the EU average is 1.6, 1.8%, we can see that almost double that rate in the new member states and the Western Balkans. But the difference is only 1.52 percentage points, which is actually not very much. For backward countries, it's not really that rapid a catching up that was hoped for. And we have some countries where the distance is still increasing, like Croatia, not to speak about the very low level where Ukraine has been falling back. Once more, the key messages. So 2015 we understand as a peak for the new member states, job for the CIS and Ukraine. Somehow our average growth forecast is about 3% for the new member states, Western Balkans and Turkey, plus minus half percentage point. Household consumption is the main growth driver, but investments due to recover because conditions for private investments improve. And although there is a temporary decline of EU transfers, it may reinvigorate later. Demography and immigration lead to labor market shortage, and of course we have lots of risks that were factored in some decimal points, but for which we do not have a separate analysis. Thank you for your attention.